Okay, so with regards to the different types of accounts that you can use for this type of investing, we're going to look at a lot of different specifics. Normally going to be, okay. Which are going to be centered around the main types of accounts that we run into. Now, typically when people are looking at the type of account that they would like to utilize, it's going to be based on where they currently have funds. Now, if those funds are held in an old 401k, they're typically going to be utilizing a traditional IRA. Now, the cool thing with any of these types of accounts when it comes to looking at the differences between buying and lending on property is that any of the actual profits that are made for the actual investment are going to be treated exactly the same no matter what type of account they're in. So if you have a property that you sell within a traditional IRA, it's treated exactly the same as it's going to be for a Roth IRA. Now, a lot of people might say, well, wait a second, I thought everything from a Roth IRA was tax-free and everything from a traditional IRA was tax-deferred. And that certainly is true, but specifically for the distributions from the account that you're going to be taking. Any type of investment, when you're buying, selling, or realizing profits and income, is treated exactly the same across every single one of these types of accounts. So depending on what you're doing, it's not going to really make too much of a difference of what the actual investment is. It's going to make more of a difference as to how you would like to make the money and what type of risk you're going to be associated with being exposed to when determining the actual investment, not necessarily the viability for it in any specific type of account. Because again, remember, the only real difference between most of these is the tax consideration in contributing funds to them and the distribution tax consideration when taking money out of them for retirement purposes or personal purposes. Is when you differentiate between taxable and non-taxable types of income. So with regards to these different types of plans, let's just kind of briefly go over what exactly they all mean. The traditional IRA people are very familiar with. It's tax deferred. You normally roll over from a traditional IRA is rolled over into from an old 401k. With a Roth IRA, you can roll over from a Roth 401k, but most of the time people will start with contributions and do Roth conversions in order to fund those types of plans. Now, with regard to SEP, simple, and individual 401k plans, these are going to be business plans. Now, they have to be associated with a particular business that you are going to be operating. And now this can be a self-employed business, so you can operate these as a self-employed individual. And each one of them have their own inherent benefits and drawbacks. So with a simple IRA, they're a little bit more antiquated and not a lot of people opt for these anymore. Some people that utilize businesses that maybe have lots of seasonal employees might like them, but they're kind of complicated. I won't get too far into that. Now, for individuals that are looking to invest in real estate, most of you invest in real estate outside of an IRA. So you have personal experience and maybe are generating personal self-employed income from investments outside of this. So the solo 401k or the individual 401k and the SEP IRA might be a very good fit for you for these types of plans. Now, I would recommend that you look specifically at how much money you're making as a self-employed individual or as your investment income and how you are structuring your business as to which one might make the most sense. Now, one thing that people run into a lot when they think about buying real estate or investing in real estate, maybe with a loan, is that, you know, with people that don't have maybe a sizable 401k or have been saving money into one of these plans for a long time, is how exactly do you get enough money to make one of these types of investments into one of these types of plans? Well, utilizing a self-employed business plan, such as a SEP IRA, simple IRA, or individual 401k plan, can definitely be the answer for that. The maximum contribution for a traditional or Roth IRA for this year is $6,000 for individuals under the age of 50 and a half and $7,000 for individuals over the age of 50 and a half. Now, with a SEP IRA and an individual 401k plan, it's almost $60,000 that you can get into these types of plans on an annual basis, which is a significantly higher margin than the other two. Now, how do you do that? Well, with a SEP IRA, you take the amount of money that you are paying yourself as a salary, so Social Security, self-employment wage qualifying income, and you can contribute up to 25% of that, not to exceed $56,000 plus your $6,000 or $7,000 IRA annual contribution. With the individual 401k plan, that's pretty cool. You can actually take $19,000 of your personal income and contribute it, plus up to 25% of your net operating income of business and contribute it into that plan as well. The really cool parts of that plan is that you can also, if you're filing as a subchapter S, have significant tax deductions onto yourself personally, and also be able to split up where you're actually taking the money from, and you don't have to be paying yourself or making a ton of money to potentially max out the contribution to that type of plan. Now, additionally, I have education and health savings accounts up there. While these certainly are types of plans that you can use for self-directed and real estate investing, they have much lower contribution limits for the educational savings account and the health savings account. With the current legislation of the Affordable Care Act, there are not a lot of plans that qualify for a health savings account. I'll be teaching a class on that coming up next month if you're interested during open enrollment, about what exactly an HSA self-directed account looks like and how to qualify for one. But currently, a lot of the plans that are on the Affordable Care Act marketplace do not qualify for those types of accounts. So I put those up there just as a point of education, not necessarily something that you might be able to utilize to great effect. Okay, so now that we kind of understand the basics of what exactly you can utilize for self-direction, how do you find these deals without having kind of like a stock ticker sheet or something to go off of? Well, the beauty of this is that you get to use not only whom you know to invest, but also into what you know investing as well. Now, that might sound a little bit convoluted, so let me kind of explain what I'm talking about. Is that instead of having you do research on large companies and looking at prospectuses and earnings, you can actually do these things a lot more local and figure out what exactly is going to work for you and how it's going to work for you as well. So when you're looking at something such as real estate, it's very hands-on approach to actually going out and finding what deal is going to work. And also, if you're going to try to lend someone money, you're going to want to know that that person on a personal level has the intention of repaying you as well. So you get to network actually face-to-face if they are local to you and actually figure out what's going to work best for your retirement plan and which direction you'd like to go with it, which is a really cool aspect of this, because as much as we all would like it, if we're buying Coca-Cola, we're not going to get typically a sit-down meeting with the CEO to ask them how they think the next year is going to go. You're having a little bit of blind faith in the research for investing in securities, as opposed to a little bit more hands-on and a little bit more deeper research that you can do when it comes to investing in things that are self-directed in nature. So how exactly does this work with regard to actually purchasing the assets? It's a very interesting way that this works, because remember, you're not actually with an IRA going to actually be purchasing anything or lending anything to someone personally. You're actually going to be doing it in the name of the IRA itself. So instead of having John Smith or John Smith's LLC, the name of the buyer or the lender, you're actually going to be doing things in the name of the IRA. When people do this, the biggest obstacle that I see and the biggest headache that typically comes up with regards to people having a perceived opinion of inefficiency with self-directed IRAs is that they start things off in their personal name first. They don't actually go through the process of involving Advanta or notifying the IRA custodian of their intent to do what they're about to do until it's well down the road of what's actually happening. So the biggest thing I can recommend to you as the potential IRA client or as an existing IRA client, excuse me, is to, from the very beginning of when you actually think that you're going to do something, one moment. Okay, sorry, someone was still having an issue with the audio. So with regard to doing this correctly, you really need to make sure that you are notifying things run very efficiently for you. Now, in an interesting sense, the IRA is a separate legal entity from you personally. It is as different of as different of an entity as you, if anyone that is listening to this presentation is, and I am. It literally is a separate entity from you. So you need to make sure that everything is titled correctly in the name of that entity. So properties are purchased in, notes are written in the name of Advanta IRA for benefit of John Smith's IRA. And all funds from the purchase or the actual funding of the deal need to come from the IRA directly. And then all of the income comes back to the IRA as well. So if you think about this in terms of So if you think about this in terms of what is going to be happening with a typical security, you'll be receiving a dividend or a quarterly payment distribution to the shareholders of the company. Well, in this case, instead of getting those types of payments, you're going to be getting principal and interest note payments, or you'll be getting rental payments, or the proceeds from the sale of the house when you sell it, or the payoff on the note when someone sells the property that you have lent on to satisfy the mortgage in the chain of that transaction. So that's an important aspect to remember. It's maybe seeming for people that have done this before a little bit pedestrian, but it is something very important to note. And the name of the game with a lot of things in real estate is speed and efficiency. The faster you can do something, the bigger advantage you have over someone else that might be trying to purchase a property or maybe trying to lend on a deal. And the more that we can help with that, the better off most of our clients typically will be. So a few key things to remember, especially when you're looking to invest in real estate, is that if you have an old 401k, the biggest thing to do that I see a lot of people do, or I talk to that maybe not be a good fit or maybe aren't able to utilize an IRA, the fact that they had an old 401k, they left a job, and now they took the old 401k and they just took a distribution of it. They elected to pay taxes and penalties, get it out, and then invest in real estate. Now, while they're actually getting to the point of being able to invest in real estate, they actually are taking a significant tax hit and then incurring taxes presently and then in the future as well. We actually have, before we get too far into this, we have a question. Thank you, Rich. Can you only transfer old 401k plans from previous employers to an IRA, or can you transfer your current employee-funded 401k to an IRA? Very good question. So with regard to that, once you have a 401k, there are a couple things that are deemed to be qualifying events for being able to move out of it, typically, and put an asterisk next is typically in my answer. One, you can move the funds out of that 401k plan once you reach the age of 59 and a half, which is the general age of retirement in the United States. If you have terminated employment, if you die or become disabled. Now, those last two typically aren't something anyone wants to have happen. So those are the ways that you can typically get money out of an old 401k to an IRA. Now, if you're currently employed with that employer and you're not of the age of 51 and a half or disabled, well, then what do? It's not a required law that you have to allow participants in a 401k plan to roll out while they are still employed. Employers can and administrators can restrict that access to those funds. So if you'd like to access funds that are in a current employer's 401k, what you need to do is contact the plan administrator or your HR representative and ask them if you can do an in-service rollover. Repeat that, an service rollover. And if they say yes, then great, you can certainly move those funds out. If they say no, unfortunately, that is their right to do so, so long as that it is stated in the adopting plan agreement for that 401k plan. So it's not as easy as a clear-cut yes or no answer, Rich. It's something that you do need to follow up on with your current 401k plan administrator, but the answer is potentially, but I would say it's probably a 70% chance no, that you're going to be able to roll those funds out unless you're over 59 and a half. So the key point I like to get across to people in investing in real estate with an IRA, especially if you haven't done a rollover yet or you just left a job, is absolutely leave those funds in the 401k and roll them to an IRA, because you will lose so much money if you take a 401k plan as a full distribution. One, you're going to be paying income tax on the entirety of that distribution if you remove the funds from that 401k plan. And then any earnings that you have associated with those funds that you take out, so you buy a piece of property, are going to be taxed as well at personal income rates. So one, you're going to have to pay taxes on it. A 401k in almost any circumstance will put you into a higher tax bracket. You're also going to have to pay a 10% early distribution penalty, and then also 401k plan distributions that are not a qualifying distribution have mandated 20% withholding. So even if you're not going to have to pay 20% in taxes, they're going to withhold 20% from the amount distributed, plus you're paying a 10% penalty on the total. So your ability to lose between 20, 30, even more percent of your purchasing power is an absolute reality for people. And it's something I hate to see happen, especially when it doesn't need to, because people don't realize that you can invest in things like real estate with those funds directly. Now, an example of that would be that a client has $100,000 in an IRA. They instead take a distribution, they get a 10% early withdrawal penalty, and then they have to face personal income taxes for that. But by using a self-directed IRA, you can do the exact same investment, not pay any taxes on the distribution, not pay any taxes on the income or the sale of that property or the income from that note as well. So it's a big point to hammer home is that you do have that old 401k, or you know someone that has one, is thinking about distributing it to invest in something. There really isn't a valid reason I can think of to do it unless you have personal expenses that need to be paid that you can't get around. Then absolutely, everyone's situation is different, but I would highly encourage people not to take those funds out unless they have to do it for something personal. Okay, Will's got a question. Can a separate 401k from each spouse be combined into one new self-directed IRA? The answer to that is not as clear as a yes or no. On face value, you cannot combine a spouse's account with another's account. They each have to remain individual and separate from each other. Now, does that mean that you cannot bring them together in a self-directed fashion and use those funds in a singular fund? Absolutely not. You can partner them together, and in different cases, you can potentially have them partnered into a singular entity that will be able to invest as a single pool of combined cash to essentially accomplish that combination while still maintaining the segregation that is needed for IRS standards. So the way that would look is that if you have a 401k, you and your spouse, or really you and anyone for that matter, open self-directed IRAs. You can partner them as tenants in common, so defining the interests on the deed for a particular property purchase. Or you can also do it in a fashion where you maybe form a new LLC and then partner them into that LLC, in which case they would invest into the property or the note singularly. So yes, you can certainly invest them together. You just can't combine them into like a joint IRA. There's no such thing as that. All right, we got some great questions rolling. Keep them coming in. Let's see. Tawana asked, how do you get proof of funds for a real estate deal using your self-directed IRA? It's as easy as just giving us a call, letting us know how you would, how much you would like on that proof of funds, because we understand if you have money in your account that exceeds the amount of the offer, you don't want to kind of show your whole hand of cards and doing that. So just give us a call. We'll issue you one. Typically takes us about 20, 30 minutes to get one generated, and we can certainly get that right over to you. Just give your account manager a call here. We'll get you a proof of funds letter signed. Not a problem. Dinesh, yes, we do record all of our webinars. Cheryl asks, do I have a choice in which property I want to purchase using my self-directed IRA? Absolutely. We do not provide the properties for you to purchase. It is up to you to go out and find the property you are looking to invest in. So it's not something that you're going to come to Advanta and we say, hey, here's the current book of properties that you can potentially invest in. You would go out, you would do the due diligence on the property, negotiate the deal, and then you would contact us to facilitate doing it through your IRA. So it's all self-procured. It's not something that you would necessarily have provided to by us. All right, Jay asks, if you are self-employed in a tax-deferred retirement plan, when would it make sense to roll over to that account to a Roth given current lower income taxes so that all future investments are made from the Roth would be tax-free? I need to preface this with we are not tax advisors, nor do we give legal or investment advice. But in an academic framing of that question, and you are contributing to a traditional type retirement plan, whether that be a SEP, a simple, or a traditional 401k, what you're talking about doing is actually a Roth conversion, not a rollover, so that way you can pay the taxes on the current value of what you are converting instead of at a potentially higher future tax rate. Things that I've seen clients look at in the past, and your mileage may vary, so please consult with a tax advisor, would be any year that you potentially show low income, that you have carry forward losses, or that you have significant expenditures such as capital outlays, or something that would be a high amount of deductibility for you personally to do. So if you're filing as a subchapter S and you have capital expenditures or reinvestments or carry forward losses, that would potentially allow you to take a lot of deductions in that given year. Because remember, when you do a conversion, it is calculated and paid for out of your personal taxes and personal funds. So if you're going to be upping the amount of modified adjusted gross income for a given year, it would make sense to do it in a year in which you have a lot of ability to reduce that total MAGI number. Can a Roth be a self-directed IRA, Jay? Absolutely. Cheryl, the fees that are incurred by doing this are very minimal. We typically charge by the asset, or if you're looking to do a large amounts of investing, we can just do a flat rate for the value of the account. Typically, it's very affordable. We charge $300 per year, roughly per year per property, if you're doing one property at a time. Our other fees, I'm always happy to discuss with you in detail. If you can frame out the deal you'd like to do, I can tell you exactly how much it'd be. Grab my contact information at the end of this, and I will certainly be happy to review that with you in detail. Apruva asks, can my self-directed IRA buy a property that is currently owned by me in a personal capacity? Unfortunately not. It does have to be newly acquired property. It cannot be something that you personally own or have a personal interest in. It has to be at an arm's length. With that said, brothers and sisters are not considered disqualified individuals. So if you buy a property from someone like that, it is fine. John, I believe we kind of reviewed that in the last answer. You can only use it for investment purposes. Okay, Samuel asks, as a real estate investor, how can I use private funding from a participating IRA or 401k that hasn't rolled over to a Roth and still protect them from paying taxes on these funds? I hope I'm asking the question correctly. Let me just look at that for a brief moment. That's real estate. Thays, we are going to get to lending. I've just had a rush of questions I was trying to get through. But I do realize that we are running a little bit on time, so thanks for the update. Let's keep the questions coming in. Once we get to another kind of break, let's get through some case studies, and then we can get a few more questions. But just file them in, and I will certainly get into those in a moment. All right. So benefits of holding real estate directly. Now, when we look at this again, in a general sense, again, this is going to be buying versus lending. So what is a good aspect of buying real estate? Well, you get to collect monthly rent. So you get to have a potential influx in the amount of monthly income that your IRA would be receiving, as opposed to lending someone money when it's a fixed rate of return. So let's say the property values go significantly higher in your area. You have a new Whole Foods, a gym goes up, they redo the city park next to your house. There's a lot of things that are going very well in the area that your house is located in. But you know, with if you were lending someone money, you don't get to appreciate that rise in potential value of the rental income for that area. So rental income can be very great. You can certainly go from 1,200 to 2,400 in a given area within a few years. It's not inherently unreasonable depending on the area and the type of house that you have. The nice thing about it is that the IRA is owning a tangible piece of investment, or the investment is tangible. You can reach out and literally touch it. There is, there's nothing kind of ethereal about the investment. It is there. You can walk out and touch it. If something happens, if the economy crashes, you still have an investment. It's not going to go bankrupt. The property, even if it diminishes in value, will still always be there. And then once you buy a piece of real estate, you can also realize the appreciation and the value when you sell it. Unlike with a note, which you lend someone, let's say $100,000 at 10% interest or whatever the interest rate happens to be, that's what you're going to get. You're going to get your uh, interest and your principal back. So essentially, at the end of that, you are going to make only a certain amount of money, depending on how long the note stays outstanding. The nice thing about doing this through an IRA is that none of the potential taxes that you would pay outside of an IRA apply. So ordinary income from the rental expenses, so potential long or short-term capital gains are going to be avoided as well. You also get to qualify the tenants, and there's also no requirement as to what type of property your IRA can buy. So if your area is rich in development and vacant land, your IRA can certainly buy vacant land. If the primary basis in investing in real estate in your certain area is agricultural, whether that be for, let's say, livestock or farming. We have clients that invest in timber rights, of all things. So you can do a lot of different things with real estate. There's not one size fits all, and depending on where you would like to invest, it's certainly going to be something very beneficial for you to understand that you can do what you would like and what's going to actually make you money. So these are the primary benefits to holding a piece of real estate in your IRA. So how exactly does it look when you buy something within an IRA? So in this very basic sense, John Smith identified a property being sold at a short sale. So the bank is agreeing to sell the property that someone currently owns, and then forgive the loan by virtue of this sale. So you go out and, or should say, in this case, John goes out and makes an offer that's accepted at $120,000. He has a traditional IRA, and the deal is funded from his IRA directly. So he gets the property, he rents it out for $1,200 a month for 2 years. So that's $28,800. That's just a hair shy of $30,000 in income that he's receiving from that property over 2 years. Now, that is all going directly back to the IRA. He's paying no ordinary income taxes on that. The only tax that you can kind of associate with this type of investing is property taxes. Unfortunately, there is no avoiding the local property taxes with regards to investing in real estate. I'll just go back. You really have to kind of factor that in. That is what you're going to be on the hook for when you're doing this type of investing. You're not going to get away from being able to have property taxes be paid. If you don't pay them, well, then the county will come in and take your property. So it's highly recommended that you make sure you stay on top of those. So then in 2 years, John sells the property for $170,000. So he made $50,000 of upside profit in the IRA. So no taxes are going to be paid on any of the income from that. So the $28,800 in rent, the $50,000 of upside profit. Now, depending on how close to the 2 year mark the IRA was on selling that is going to really show you whether he got to avoid the short or long-term capital gains for that. So when you look at it, you really do get to avoid a lot of taxes with this. And the really big benefit to this, and people can make the argument sometimes that if you're doing a long-term rental, the ability to hide behind depreciation and potentially amortization doing things personally is lost. And that is a very valid point. But if you're doing something like this, where you're planning on turning around rentals within about the 2-year mark, it's hugely important, because the biggest thing to look at here is that yes, he made $78,000, almost $80,000 in his IRA and didn't pay taxes on it, which is phenomenal. But in the other converse context, he could have done this personally. He could have had 120 grand and also made $78,800. But each year he would have had to make sure he escrowed or kept aside money to pay taxes. With an IRA, you don't ever have to worry about that. So not only do you get to make the money and not pay taxes, you get to redeploy that money at a quicker pace than you would if you did it outside of the IRA, because you'd never have to worry about escrowing out your taxes for that particular deal. You get to take more money and deploy it quicker to potentially make more money quicker. So that's one of the biggest things that I like to point out to people, is that you have the ability to make the money, not pay taxes, but also get it redeployed at a much quicker rate than you would if you were doing it personally. All right, we got a bunch more questions. Let's jump through a few of these real quick. Can a bank loan be used to buy property? The self-directed IRA would pay the down payment. Lawrence, yes, it can. It does have to be what's called a non-recourse loan, meaning the IRA would be taking the loan out. You would not be offering any personal guarantee to that note, and the IRA would be responsible for making all payments. It is something that I would recommend if you qualify for a solo 401k and you're looking to do financing. That's a very powerful tool for doing finance purchases. It's something that I don't want to get too much down a rabbit hole with, because I literally teach a 1-hour class on 401ks and financing, with those types of plans. But the answer to your question is yes, it does have to be a non-recourse loan, though. Sharon asks, can you fund a HELOC for someone who is not related? Yeah, I mean, if they're not related to you, they're not a mother, father, son, daughter, or spouse, and they are at arm's length, you could certainly do something like that if you wanted to. I don't think I've ever really seen it structured like that, but it's not something I would see to be an issue. VJ, if 2 IRA LLCs to invest together on one property, can they do so as something like tenants in common? Yeah, absolutely. You could have ABC LLC as 50% owner and XYZ LLC as 50% owner on a property. There's no problem with that. In some cases, people might do it a little bit differently with regards to they might form a new LLC and have a singular investor do it. But that's just kind of how I've seen it. John asks, can you use a self-directed sorry, I went back too far. I want to use funds to purchase real estate from their IRA and 401k. That is fine. Farhad asks, when property values go up, can we refinance and take cash out of equity for new purchases? You certainly can. That is assuming that you did finance the deal and did not buy cash. Can a person's deed sell a purpose? I'm assuming, William, you're asking if you can do a personally owned property to a self-directed IRA, and unfortunately no, but by virtue of the fact that an IRA can buy property, it certainly can receive a deed from anyone that is not a disqualified individual. John, yes, the property taxes have to be paid from the self-directed IRA. Any expense directly related to the asset itself, such as it needs a new water heater, it needs a new kitchen stove, property taxes all have to be paid from funds within the IRA. Okay, let's see. Rich asks, can you do a 1031 exchange in the IRA to get away from the gains tax? This is kind of an interesting question. So capital gains are not assessed to an IRA. So you don't need to do a 1031 on really 90% of any regard with an IRA. Now, there is a particular tax that is levied when IRAs get into financing purchases that 401ks are not associated with. That's why I kind of briefly mentioned that using a 401k, if you're going to be doing finance purchases, is very powerful. Now, within that regard, to mitigate what's called a debt finance income tax, you can do a 1031 within an IRA. Sorry if I kind of lost anyone with that, but yes, that's really the only way that a 1031 would be applicable with inside of an IRA. Sharon asks, how do you pay property tax and insurance? We just set that up as a recurring expense here at Advanta, or you can just use your online portal and we pay it directly the following business day. Tawana asks, can I continue to use the profits that are going back into the IRA to purchase more real estate? Absolutely. We have plans to do that all the time. Apurva has a big question. Let's see. Can you buy commercial property in a partnership with the self-directed 401k? Yes. And if my bank is willing to give a commercial loan to the 401k, and if yes, and if my bank is willing to give a loan to buy that commercial property for 400k down payment, and the loan balance, does the 400k have to come to the 401k, or can it come from my personal account? So if you want to buy within the 401k, yes, the 401k needs to have the money for the down payment. That's pretty crucial in that. Okay, last question, then we'll move on. Again, keep rolling these in. Great questions. Really happy people are so engaged. If a self-directed IRA forms a single-member LLC to purchase real estate and gets a loan, does recourse against the LLC? Yes. So even if you are borrowing money for an IRA purchase, Jay, and you have a single-member LLC, it has to be fully non-recourse. Think about an IRA a single member LLC within an IRA strictly just as a pass through directly to the IRA. It's just as a shell extension. There is no different rules regarding that. It does have to be non-recourse to that effect. And okay, one last question. I lied. Can I personally partner with a self-directed IRA to purchase a property? Yes, Lawrence, you can. It does have to be done as a tenant in common, and you cannot float an expense from your IRA to yourself, meaning that if you have property taxes or an AC unit or something, you do have to have the funds in each respective account in order to be able to pay that. All right, again, we're going to get back to the presentation. Keep firing off the questions. We'll take a break in a minute to get back to that. Okay, so other ways that you can look at real estate. Again, remember I said that you don't necessarily have to have one particular prescribed method for this. You can do really whatever makes it work. So you could do a fix and flip. So in this case, Rachel has 150K in a Roth IRA. She buys a foreclosed property at the day of the sale for 100K. Now remember, all expenses related to an IRA purchase of a property have to be paid from the IRA. So the IRA pays 30K for rehabbing the property. So remember, she bought it for 100, she has 150, she bought it for 100, she paid 30 to fix it up, so she still got 20 in reserves, and then she turns around and sells the property for 210. Now, this is fantastic. She has made $80,000 on this deal, and everything flows directly back into the IRA tax-free for the next deal. And remember, it doesn't matter in this case if it was a Roth, traditional, or anything else. It is strictly just going to be cash in, cash out for the IRA, and then she's not paying any taxes on that. So the only time she has to worry about paying taxes, and the beautiful thing with this is that she had a Roth IRA, is that when she put money in, she didn't get to take a tax deduction. So now she gets to distribute all of that to herself personally whenever she would like once it's qualified, and she has to pay 0 taxes. Very cool, Jesse. Very cool on that one for Rachel's deal. Now, manufactured home communities or manufactured homes or trailers are one of the cooler instances that I've seen to to make a lot of money in an IRA. One of the larger growths that I ever saw with a client, and this was back when I was doing investments for clients, was a client I had in North Georgia that bought a manufactured home or mobile home community in his IRA. He bought a 30, or it started out as a 10 lot park. And he managed to get the IRA, signed all the paperwork, but managed to get it replatted into a 30 lot park. He bought it for 110K and managed to make it from 10 to 30 available trailer spaces in Georgia. Now he created revenue in this from the installment contracts on the trailers. So he would bring in a trailer, rent it out to someone, then he would turn around and sell it to them and hold the financing on it and then charge them lot rent. For that. So it was a very interesting scenario with this individual, and he made a ton of money doing it. And all of the revenue is collected by the SEP IRA, and there's no taxes paid on any of it. So that was really cool, and I really enjoyed getting to work on that client's account for several years when we'd actually buy the trailers in the IRA, pay to have them moved in, sign a lease to a tenant, sell it out to them, hold the note on it, and then also write a rental agreement for the land underneath of it once they had purchased it. It was pretty cool stuff. Now, of course, this is not all going to be perfect and easy. There are issues with buying real estate. A lot of people like to look at, and there's a lot of validity to realizing there are liability issues with real estate. People can trip, can fall, terrible accidents can happen, houses can burn down, people can get injured or even die. And then, there is a view that the owner of that property is liable in some cases wholly for the issues with that property. So that is a very big downside to owning a piece of property. Now, you personally are not going to be liable for an IRA on property. Remember in the beginning of this presentation, there might have been audio issues, but a IRA owned property, an IRA is a separate legal entity from you for the purpose of ownership and liability standards. So the IRA is the one that the liability passes back to. Now, just like I said, you have to pay the property taxes and expenses. Any insurance that needs to be held on the property needs to be held and paid for by the IRA. So you need to make sure that you have good insurance. And the biggest thing I recommend to people is that there's a few big issues that I see a lot with buying real estate, is that they try to cover real estate under a personally held liability umbrella. I guarantee you the second you have a claim against that and they see that it's an IRA on property, the insurer will definitely deny that claim. Make sure that the insurance agent knows it's an IRA on property, have it listed under the name of the IRA, just do it correctly. And I think the statistic is something like 95% of all liability claims settle with insurance. So make sure you have good insurance. The other big issue with holding real estate in an IRA is that you have a lot of expenses that are related to real estate. If you own the property, you might need to put a new roof on eventually. You're going to have to do maintenance. You're going to have to pay property taxes. So, it might be an expense laden type asset. And you must have all of these you must have sufficient assets or cash to maintain this asset within the IRA. So between liability and expenses, real estate isn't for everyone. It's a very hands-on type of asset to hold. Now, the alternative to that is, well, if you don't want to invest in real estate directly and own it, why not lend someone money to buy the real estate instead? Instead of letting Bank of America or someone else hold a mortgage and get to kind of take over that industry, why don't you step in? And if an investor wants to buy a piece of property, your IRA can hold the first position mortgage, meaning that if they don't pay your IRA, the IRA forecloses and gets a piece of real estate. So it's a very secure way of lending someone money. Now, a mortgage is certainly a very popular method of lending money. It's very secure. You have a lot of faith that the person is going to repay you, because if they don't, the house that they purchase will go away. Now, you don't have to do that. You do definitely have a nice fixed rate of return, but your interest that you can charge that would be acceptable in your market is going to be probably significantly less than if you did something where the risk was higher. Just like you hear people tout on TV and in books all the time, it's risk versus reward. The higher the risk, typically the greater the reward. The lower the risk, such as with a mortgage, where they're typically going to pay you, you're not going to be seeing very, very high interest rates being able to be charged. Now, you as the client get to determine the interest rate. Now, you do need to be aware that each state that you lend in, so where the borrower is going to have its own regulations with regards to how much interest or effective interest that you can charge. Now, this is going to be defined under laws which are called usury laws. It's not the easiest thing to say, but USURY. So usury laws are what you're going to need to check to make sure that you're not violating any of those laws in the particular state that you're lending to. And that has a lot more to do with when you're doing unsecured lending. So if you want to lend someone money personally and there's no security past their handshake and promise to repay your IRA, then go for it. You certainly can do that. One of the cooler types of investments that I've seen with clients in lending has been what's called equity participation, where, and this can be done either secured or unsecured. So if someone is purchasing a piece of real estate, and again, remember I said the nice thing about real estate is that it can go up in value, and maybe the downside to a loan is that you do not get to appreciate that, that upside on the sale, is that instead of giving them a fixed interest rate or even a payment schedule, you lend them, let's say, $100,000, and then instead of making 8–10% interest on a monthly basis, they say, hey, we will pay you, let's say, 1%, or just make principal payments only. And then at the sale of the property, you get 10, 20, whatever the percentage of the net profits of the property is. So if the property goes up in value and they make a profit, then you get to enjoy that increase in value. So definitely some cool ways to structure this kind of stuff. Let's check out the questions. I see that we got a few popping up there. I'm going to find where we left off because we got plenty of questions. Was that Bill Cook? I'm sure Bill has done plenty of those kinds of deals. That wasn't the first person that I ever saw it from with regards to equity participation, but I do know Bill personally. I do know he likes that kind of stuff and getting creative with it. For any of you, those that aren't familiar, Bill Cook is a very well-known and respected investor and mentor in the Southeast United States. He and his wife do a lot of education. I wholeheartedly endorse him if you're looking for someone to learn a lot from. Find his classes. He does stuff between here and Atlanta and other parts of the United States. Great guy, fantastic to learn from. So Rich asked, so to grow your IRA, you show a lot of flips but not buy and holds. Is that most used method for your clients? It varies, but I would say, Rich, that the majority of our clients do more turnover type real estate, although it's hard. It kind of varies with the market as well. I'm kind of changing my answer as I give it. I would say it really just determines a lot on the market that you have in the particular area and the propensity of that client to tolerate risks. So, we certainly have clients that have held properties for 15 years, the same property. And they just like that continual revenue stream of having that rent check come in, and it's great for them. But I would say probably the slim majority of people, probably about 50 to 60%, probably turn over the property they buy every 2 years or so. So while it may not necessarily be a fix and flip, it's not necessarily something for a super long-term hold. So is your IRA its own LLC then? No, you can structure it into being in an LLC, but it isn't inherently one to begin with. It's just a separate entity from you. Your IRA can certainly be structured to where it buys the sole membership in an LLC and you structure it that way, but it doesn't have to be. Is the property held in a checkbook LLC owned by the IRA? Then should it be insured by the LLC? Yes. So if you own a piece of property and you've structured your IRA to be the owner of an LLC, a lot of people call that checkbook control, then the LLC is what's going to need to have the insurance policy. is going to need to be insured under a policy held by that LLC directly, not by the IRA. So remember, whoever is on title to the IRA-owned property needs to be the entity or the person that is acquiring the insurance. Okay, do you still get to depreciate your assets in an IRA for tax benefits? 90% of the time, no. The reason is that your IRA does not file a tax return, and you don't file this on your personal taxes. The only time that you get to take advantage of depreciation is when you finance a property in the IRA, because at that point, an IRA with a financed piece of property does have to file a tax return. Okay, Farhad. If lending as a hard money lender, where to obtain proper loan documents from? Just wherever you would obtain them from personally. So I would recommend, first and foremost, someone that's good, a good attorney would be a good place to start. CPAs, title companies typically have access to good vetted loan documents. I would say any of those places are a good place to start, but we do not provide the documentation for that. Dinesh asks, can the company be registered in any state irrespective of where the property is located? I would say yes with an asterisk, unless there is some requirement maybe by a homeowners association or a co-op board or something where you're buying the property. If that applies, that would require for state registered entities only to purchase them, but there is no IRS, federal, or business regulation that we have that would define you only being able to register an LLC in the state that you are buying the property in. Okay, Dinesh, there's a limitation of $50,000 to take a loan from any existing 401k account. Can one take out more for an IRA investment? Okay, that brings up a good question, Dinesh. So when you're talking about doing an IRA investment, what he posed in that question is that with a 401k account, you can take a personal loan of $50,000 up to half of your vested balance in that 401k. Now, if you're doing it and if you don't have access to roll those 401k funds over to an IRA, can you take that $50,000 loan out of the 401k and put it in an IRA? Unfortunately not. Participant loans are not qualified to do a rollover. So where you could get that IRA invested with, so where you could take that 50k and invest it with an IRA would be as a tenant in common or as a partnership. You couldn't necessarily take that 50 grand that you took as a personal loan from an existing 401k and directly put it into an IRA. It essentially at that point becomes personally held cash. Anything that you make on that 50 grand that you've taken as a loan from your 401k, any returns on that would be personally taxable. And it's not qualified for a rollover and has to be paid back to that 401k. But great question, Dinesh. Thank you. All right, we'll get through this last little part. We're coming up on the end. So the benefits of private lending is you get to act as the bank in this case, and you get to determine the actual terms of the note. So you get to say, hey, my IRA is going to lend you money at 8% over 15 years with a balloon at 15, or it's going to be an adjustable rate mortgage or a fixed year 30. You get to be really creative and really make it work so that both people at this particular juncture can have a good experience with it. Your IRA can make money, they can make money, everyone eats in this scenario. You can set the rate at which your IRA grows. So unlike with investing in real estate where it might be a touch speculative, you can have a very defined plan for the growth of your IRA with regards to how much interest you're charging, how long it's going to be outstanding for. What kind of other caveats are going to be written into that loan are going to be completely at the discretion of you as the IRA owner. And then when you lend someone money, a investor local to us named Pete has a nice saying that I'm going to steal right here. It's that when someone trips and falls in a house, they don't trip and fall over the mortgage. The piece of paper that the loan is written on is not indicative of liability in 99% of the cases. So you do get to insulate your IRA from liability in that regard. And also there's a very low cost to having a mortgage or a loan in the IRA. Once you have lent someone the money, you're not responsible for putting a new roof on, you're not responsible for the property taxes. It's pretty straightforward. And then it's a lot easier to partner funds on a loan than it is sometimes for doing an IRA property purchase. Rich, URL for Bill Cook, I would Google him. I honestly can't remember what a good URL for him is. Or if you grab my contact information at the end of it, I can do a little research and send that out to you. All right. Oh. So how these things look. So one of the larger accounts that we have here at Advanta strictly does first mortgages for investors and flippers in South Florida. All the loans are secured by a first mortgage. They have prepayment penalties. So his enticement is for these people to keep it long term, for him to get a longer fixed rate of return. But if they repay early, then he does get a little bit of a bonus for that. All interest and payoffs are non-taxable, and everything to him personally is completely tax-free. Then the equity participation loan that I mentioned earlier is pretty cool. So in this case, Jane and Andy know a contractor that flips properties. They lend 50-50 from each account for the rehabs. And then instead of getting an interest rate written into the note, their respective IRAs get 30% of the profits at sale. So they aren't getting any monthly payments from this. They're then in turn, when the property sells, going to get paid 30% of the profits. So if there's $30,000 at the end of it, that is profit on the sale. Sorry, so if they are getting, there's $100,000 profit and they get 30% of that. So each account would get $15,000 plus their underlying principal on that loan. So it's a pretty cool way to have a investment structured with equity participation. But now there are some pitfalls, and there certainly are some things to look out for. The IRAs typically does not realize appreciation in the property value. So if the property value skyrockets, unless you have equity participation written into that loan, you're not going to get to enjoy that. So if you lent someone $100,000 for the purchase of a property just on a standard 15 or 30-year mortgage, and then they go to sell that property and it's quadrupled in value and it's 400 grand now, sorry, you get your 100 grand plus any interest that you made. They get to reap all the rewards of the property value increasing. But again, you didn't have to worry about any of the property taxes, maintenance, or liability that went along with holding that. Now, if someone doesn't pay you and you do have a mortgage, you do have to pay, the IRA has to pay for any expenses related to that foreclosure lawsuit. That's not something you pay personally, and that can be high depending on the state that you're in. So that is something that you do need to very seriously consider when you're qualifying the borrower for these notes. And then if you don't have a security interest on the note, it could be very hard or even impossible to collect in the event of non-payment, because then you're going to have to sue that person for repayment of that loan. And then that kind of segues nicely into the last point up here, is that you have to have a reliance on the individual to pay, and that can be problematic simply for general human nature. Now, that's pretty much it. I would encourage you, to reach out to me with any direct questions that you have. I do apologize for the audio issues in the beginning of this, but I'm glad that we got those figured out. We got plenty of questions rolling in, so don't bounce off just yet. And please feel free to fire in, any questions that you have. Yes, what box is the title of the seminar, September 13th and 14th? That is in Atlanta, Georgia. Can I use the IRA for funding personally owned wholesale business when I need to buy upfront and can't do an A to B closing? Unfortunately, no. So the big restriction on that is that you have to segregate your IRA and your personal businesses from each other. So you can't directly benefit the IRA from your personal business, and your IRA and your personal business cannot directly benefit each other. So it has to be at arm's length for things like that. But a good question. You can partner together, but you can't necessarily fund one from the other. All right, well, it looks like that is pretty much the end of the questions. I don't see any more rolling in, so I'll let everyone go. We're hitting right up on about 1 o'clock mark. Thank you, everyone, for joining me today. I really appreciate you Oh, great, Rich. Yeah, just give me a call. That'd be awesome. Just here till about 4 o'clock this afternoon, or just shoot me an email and we can make an appointment for that. That's awesome that you can do that. We'll get you squared away. All right. And again, thank you, and have a great rest of your day.